Money on my mind, 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 money on my mind. So money is all I think of. Money on my mind, 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 money on my mind. So money is all I think of.
All right. Money is on my mind indeed. Yes, you guys. Thank you for tuning in. I am Darrin Harvey, a.k.a. Blinding McFly, a.k.a. the Money Counselor. And this is Financial State of Minds. This is a show where I help you get to that bag, manage that bag, and grow that bag as best as possible as we discuss personal finance, financial literacy, and all things related to money. And today we're back yet again with my boy, Shabazz is back in the building. Thank you for joining us back on the show, Shabazz. How you doing today?
Doing excellent, man. It's always good to be here, man, and talk about some of our favorite things that we specialize in, right?
Absolutely, and that's why I invited you back on here, because today I wanted to do an hour-long episode, one-stop shop episode on credit repair. Why credit is important, what it is, how to go about building up your credit, fixing your credit if it needs to be repaired, and some of the options listeners can go about when it comes to repairing their credit. So you being in the business for a long time, I thought it made sense for you to bring yourself up here. I've been doing this for a while too, so I know just a little bit about credit repair. Right. But before we get into how people can either improve their credit score to the goal, which is, the goal is always 800, folks. I want everybody listening to be at a credit score at 800 one day. That's the goal. But how to get to the goal of 800, before we get into how, I want to talk about credit in general, like the concept of credit, the concept of credit score, why it's important. So I've talked about this previously. If you've been listening, longtime listeners, I have definitely talked about credit on KGPC 96.9 FM, where we're streaming right now, kgpc96.9.org. I'm not going to forget that, of course. But I've talked about it throughout my journey on Financial State of Minds as a podcast and radio show. But I've never just made a one-stop shop episode on it. And I felt it's important that if there's one episode people can go to, it's going to be this episode when it comes to how to repair and improve their credit score. So that's why I'm doing this episode with Shabazz, me being an expert too. But I'll go ahead and take the lead. Credit. So the concept of credit, I want people to understand, is the concept that you are basically getting something in advance that you have fully not paid off or paid for. That is the concept of credit. And what a credit score is the powers that be's, they put a number onto your credit worthiness. And that number can be as low as, I believe, 450, and that number can be as high as 850. So what I call the credit gods do, what the credit gods do is they create this magical system that I'm sure people have heard of called FICO. And it's a system where they use your data, which is they're gathering your data from the history of you paying stuff off, whether it's a car loan, whether it's your credit cards, whether it's your mortgage, whether it's your rent. It can actually even be utilities. Your history of paying stuff back on time, in full, without fail, or the minimum payment, whatever that agreement is. They're taking that data over your entire adulthood, basically, and they're evaluating you, listener. They're evaluating you to see when you do decide to borrow more money, whether that is a car loan, whether that is a home mortgage, whether that is a credit card. They are deciding if you are going to pay them back or not. They're deciding the likelihood of that. That is basically what FICO is trying to do, along with other credit score systems. Does that sound about right so far, Shabazz, from your experience?
No, you're on point.
So that is the point of having what is called a credit score. So when they factor in all these factors, they create a credit score of anywhere between 450 being god awful. You are atrocious. You have terrible history and terrible probability of not paying back these loans, all the way to 850. And 800 to 850 is what we consider perfect credit. Some systems actually say it's 780 to 850. But we can agree once you get to about 780 plus, you're considered perfect, and it's tiered. So I believe, and I might be off by a couple of points, so 850 to 780 or 800 is basically perfect. 800 or 780 around to about 720, 730 is considered great. 720, 730 range all the way to about 670, 680 is considered good. 780, 770 all the way down to about, I want to say 600 is considered kind of okay. Fair. Thank you for the term correction. Fair is the term. Below 600, which this is really where we need to do the work. If we're below 600 to like 540, 530 around there is considered, what is considered? Is it considered like poor is the term?
Yeah, it's bad.
Yeah. And then below that is like, we just don't even want to talk about that.
Right.
We don't want to talk about that. So that's credit. Now, Shabazz, would you like to do the duties of explaining what there's, I believe, 5 factors that create a credit score? What's a few of them? Or I'll ask you, what's the number one? What's the number one factor that is considered in FICO when it comes to developing a credit score?
I'll say 2.
Sure.
And I always explain the 2 biggest factors that make up a credit score, which is amounts owed, which is about 30%, payment history, which is 35%. So if you add both of those up, that's 65% of what makes up your score, right? So amount owed and payment history. So if you focus, and you should focus on the other ones, but they're much lower percentages like credit mixture, length of credit history, so forth. But the biggest ones are the payment history and amounts owed. So I always explain to people who are actually in a journey of actually repairing their credit that nothing doesn't drive the score more, because you have different forms of credit, right? You have, auto loans, you have mortgages, student loans, installment accounts, credit cards. So you have various areas of credit accounts. But the ones that I always say, and this is true, what drives the score more than anything? What key credit component drives the score more than anything? Credit cards. Nothing drives the score faster or makes more of an impact than credit cards. So credit card debt is probably the biggest number one killer of credit, because how the scoring system works, they understand student loans. They understand auto loans. Like if you go out and buy a new car today, they know that you're going to have that big debt for a while, right? So it's not going to just instantly just drop your score. But if you max out those credit cards, that drops your score faster than anything. Right? So amounts owed is a big part of it. And like I said, payment history. So paying on time is key, because if you have a 780 and above, right? Mm-hmm. If you have a good credit score in the 700 club, let's just say, and you have one late payment will drop you 100 points, at least 100 points.
Yeah.
And people are like, oh my God, my credit just made a huge dip, and there's a late payment drops you that much. Yes, it will. It'll go back up over time, but once that new 30-day late payment gets reported, it drops you immensely.
Absolutely. And you nailed it. So I'm going to rewind a little bit, because I really want listeners who have no idea to understand. You're right. Payment history And amount owed, or technical term you would see on Credit Karma, is going to be called utilization rate. Those two make up 65% of your credit score. That's 2/3, ladies and gentlemen. That's 2/3 of your credit score. It's just made up on, do you pay your minimum on time, day in and day out, month in and month out, and how much of your credit is being used. And when Shabazz is talking about credit card debt being so impactful, utilization rate is mainly based off of revolving lines of credit. What is revolving lines of credit? It's your credit card, listener. It's 99% of you. Your main revolving line of credit is credit cards. For those who are homeowners or who have assets, revolving lines of credit can also be something like a HELOC. The definition is of a revolving line of credit is any loan where you can use it repeatedly. It's the same loan that you're using it repeatedly. So again, for 99.9% of listeners listening right now, that is your credit card. That is why when your credit balances are so high, your credit scores are dropping like it's hot, because that's 30% of your credit score right there. And that credit usage rate, or that credit utilization rate, is tiered. So the goal really, of course, is to have no debt, but the goal is to have a utilization rate under 10%. That's the goal. So 0 is like perfect. Then you get to 10, then that's the first tier. And then 10 to 30 is like the second tier. 30 to 50 is the third tier. 50 to 70 is the fourth tier. And then anything 70 plus is we just don't want to be there. So that's how it's broken down. And your score gets impacted the more and more you move up the tiers, the more credit balance you have on a credit card. So that is where, again, the number one thing you can do, and we'll talk about this later, number one thing you can do to improve your credit score is making the minimum payments on time and keeping your balances as low as possible. And then Shabazz did a great job of mentioning the other factors, which is it's called credit mix, which is the type of loans that you've paid or you have over the years. I believe that makes up either 10 or 15% of your credit score. And that just means, do you have a history of having a home loan? Do you have a history of having a car loan, a personal loan, credit cards? Have you had medical loans or medical debts? Do you have a mix of history paying off of different types of debts? That does impact your credit score, and it can help. The other one is, of course, credit inquiries. How often have you been requesting to borrow money? The rule of thumb, of course, is that you never want to request too often, too spread apart. You only want to have 0 to 2 inquiries at any given time on your credit score. That's considered good. Anything above that, I'm just going to say you don't want that. And it's tiered about every 2 to 3 inquiries. So 2 to 4, 4 to 6, 6 to 8, you definitely don't want to be in the 6 to 8. But basically, in layman's terms, don't borrow too much money at once from too many different places. Then the final factor is just the overall credit history that you've had, meaning how long have you had your credit card? How long have you been paying it off on time? Do you have an overall length of history of being good with every particular line of credit that you have? For me, I opened up my first credit card in 2011. So that was 14 years ago. And that credit card has been paid on time every single month for 14 years. So that I have an excellent relationship with that particular credit card, which is a Bank of America credit card. I wanted to give this overview of the 5 factors. Again, payment history at 35%, credit utilization at 30%, mix of credit type, I believe it's at 15%, credit inquiries is at 10%, and your overall age of credit is 10%. That's 100%, and that is the 5 factors that make up a FICO score. And the second score system that is commonly used is, I think it's called...
So you have Vantage score?
Vantage, thank you.
Mm-hmm. Yeah.
Vantage. So You have seen Vantage on Credit Karma, listener. That is the score that most credit monitoring apps or services use. But the principles of what I talked about is nearly identical. They work the same way, but there are two different systems. The important thing to know is that your lender that you will be going to borrow money, they use FICO, which is slightly different than the other system. So just know that when the lender is pulling up your credit score, they're not using Credit Karma. They're not pulling up, oh, okay, Darrin, let's see where you're at. And they just open up Credit Karma and then they input your information they gave you. And, oh, Darrin, you have an 800. You're good. No, they use FICO. So it's important to know that both exist. But for the purposes of understanding credit and how it's impacting, those 5 factors are what is going to make up your score. So
Facts.
Though that's it. So now we have our understanding of credit scores. Now, why is credit important? Why is it good to have a good credit score? Well, the obvious answer is so you can borrow money. So, of course, right, we all need to borrow money because most of us don't have $1 million plus to buy that home that you want. Most of us do not have $30,000, $40,000, $50,000 in cash lying around to buy a car. Most of us do not have thousands of dollars, tens of thousands of dollars to pay medical bills or dental bills or stuff like that. So you're going to need to borrow at some point in your life. Unless you're just born into wealth of millions of dollars, you're going to need to borrow money. But you may be thinking, well, yeah, sure. Well, I get it. I need to borrow money, but I've gotten a car loan at a credit score at 600. I've gotten credit cards at a credit score at 600. Why do I need for it to be at the goal of 800? Shabazz, you want to answer that? Why does somebody who can easily get a car loan at 600, 650, why do they need to still get to 800?
Well, the cost to borrow money is a lot higher at 600 versus 800. So it's different brackets that you fall in with your credit score. So that's why it's key to have a good credit score, because if you have the best credit score, then you get the best interest rate. I know a lot of people don't pay attention to it, but when you put those things side by side and you look at how much it's costing me versus me having a better credit score and over time, and they look at how much more they're paying versus what they would be paying if they had that credit score, it's a big, significant difference. It's not a small difference. It's a huge difference in how much you end up paying back. A lot of clients come from mortgage brokers and real estate agents, right? And no shade against them, but I'm going to say this, and it's going to be a little controversial. Okay. Most mortgage brokers and most real estate agents don't know anything about credit. Most mortgage brokers and most real estate agents don't know anything about credit.
Absolutely.
And if they did, and not even only if they did, but if they did and if they cared enough, they wouldn't be. If you go on social media right now, you have so many of them encouraging you to get that home with that low credit score that will give you an FHA. Oh, you just need a 550 or you just need a 580. But what they're not telling you is your interest rate is going to be through the roof.
Absolutely.
That's what they're not telling you. So they say, oh, you can just get in there with this. Oh, you can just get in there with that. You do not want to do that because you're going to be paying a 30-year fixed mortgage. And what's going to happen is you're going to be paying probably, at the very least, $100K, if not more, depending on what the cost is of that property, in interest, extra in interest. And that's what they're not telling you. So you want to go in there with the best hand. You don't want to go in there with the worst or the most, oh, hey, this is the minimum requirement. You don't want to go in there with the minimum requirement because you're going to end up paying, and I'm pretty sure you could do something with an extra 50K, extra 100K, extra 200K, whatever it's going to cost you. I'm pretty sure you could find way better ways to utilize those funds instead of just paying interest, right?
Absolutely. So you nailed it right on the head. Why is it important for you to go from 650 to 800? Simple terms, you're going to save a lot of money. A lot of money. You just talked about houses. That's the goal, right? The goal is to own asset, real estate, stuff like that. That's what the American dream is about. That's what the average person wants. And I'm right there with them. But we can start before there. We don't even have to go to the house. What Shabazz just broke down also applies to cars. It's the same thing. If you walk in with a credit score of 650, you're not going to get the best rate possible. It's guaranteed. I can promise you, listener. If you walk into a bank wanting a car loan, some of them are going to say no. And then the ones that say yes, they're going to give you some of the least favorable rates.
Right.
Compared to you walk into a bank as a score of 800 holder, they're going to be begging. They're going to be fighting over your business. They're going to be like, "What? This is the best rate we can offer."
Right.
And I've been on both ends when it comes to the next thing, credit cards. That's the one everybody can relate to. Opening up a credit card when you have a credit score of 600, you're going to get quite of a different rate. That is worse, 100% of the time, compared to if you walk into the same lender and get a credit score of 800. I know this from personal experience because I have, Lord knows now, I think 15 credit cards, and I've opened them up with where my credit score was all over the place, from 650 to 700 to 830. The credit card that I opened up when I had a credit score of 650, when I desperately needed that money, they gave it to me with a 30% interest rate with barely any limit. And then when I opened up a similar credit card at the same bank, when my credit score was an 800, literally 9 months later, they gave me 5 times the credit limit immediately. And the rate is one of the best rates I have on a credit card. And it simply was the score difference. That was the difference. Why do you need a better credit score? You get more money and it's cheaper. That's why it's important to have the best credit score possible. But most of us know this. Most of us know that if you have a bad credit score, you're not getting the best rate. And if you have a good credit score, you're getting a better rate. So we'll just move right along. What can people do proactively to start the process of building their credit score? Whether they're at 750 and they're trying to get to the magical land of 800, whether they're at 700 and they're trying to get to 750 to 800, or maybe they're at 650. What can people do to start making their credit score go higher?
Well, there's a few dynamics. So some people who are stuck at a credit score, it might be debt that's holding them down, right? And if that's the case where you have debt that's keeping your score down, or you have credit, let's say you have credit card debt. Let's use that scenario because that's usually the best. It's usually, in most cases, that's the scenario.
Right.
My credit debt is too high. My utilization is too high, and I can't pay it down fast enough to get that score down, right? I mean, to make that score increase. So what can I do in the meantime? I'm going to pay it off over time, but what can I do right now that could help increase my score? So I always tell people you need to add more available credit. And the response usually is, well, they won't give me no more credit because I'm almost maxed out on the credit that I currently have. That's true. But when I say add more credit to your portfolio, I'm talking about adding credit that you can get that is not in the form of credit cards that you won't use. So adding more credit to your portfolio that you know you won't use, that's the key. So that way you have a cushion of available credit, right? That's the key. So if you add another 5 or 10, I always ask people, if you add another 5,000 or 10,000 of available credit to your credit portfolio, do you believe that'll help? And I'd be like, yeah, because I'm about $10,000 in debt. So if I added 5,000 or 10,000 of available credit to my portfolio, yeah, that'll definitely help my score go up. And that's what they need to do. And like I said, even it doesn't matter what the account is. Even if it's a rinky-dinky account, that's great because guess what? You're not going to use it. So you're always going to have that threshold of available credit. Some people may have some late payments, or they have some kind of collections or medical collections or something like that, some negative aspects that are actually keeping their score low because they have these things reported. So one of the key things is credit repair. Work on getting those things removed from your credit profile. And there's several different ways to do it. I'm pretty sure you're going to touch on that in a little bit. Yeah. So then that's the other thing. And then with some people, their score is not going up because they don't really have credit card debt, but they're not doing much with their credit. That's the key. So if you only have like one credit card, you only have one car loan, and you only got a few things that's on your credit, you need to get more things going on your credit. Because if you only have those three things, or you only have those few things that are reported, the industry standard is to have at least five accounts reported on your credit, and at least five. And even more so, I probably would say the goal is to have, I say people should have at least 5 credit cards. I know people look at credit as like credit cards like they're the devil, but really, if you know how to utilize them, they could be quite the tool, and they be quite useful.
Let's talk about that further, because that is a common misconception. Earlier, if you guys were paying attention, I said I have 15 credit cards. So now, to be technical, I have about 11 credit cards under my personal name, and I have 4 under businesses. But I have 15 total. I have no problem telling people my credit score per Credit Karma at the time of this recording is 833. I say this to say, not to brag or toot my own horn. I don't really care. I'm debt free. But I say this to say is that there's this myth that people sometimes hear. Having too much credit cards is bad. Having too much credit cards can hurt. And the truth is, it's actually, not only is it not true, it's actually the opposite. The more credit you have, the better your score can get. And Shabazz just touched on why that is. It's because you have more lines of credit available. And what he is basically saying is it's lowering your overall usage. So numbers real quick, if you have 2 credit cards, each of them have $1,000 limit. One of their credit cards is completely maxed out at $1,000. Half of 2,000 is 1,000. That's 50%. That means you have a utilization rate of 50%. You're not having the most optimal credit score if you have a balance or a utilization rate of 50%. It's not going to happen.
Right.
You open up another credit card and it's another $1,000, but you don't spend any money. So now you have $3,000 total across each of the credit cards. And now your balance or your total is still 1,000. So now you've cut it in half. So you've gone from 50% utilization rate to about 33. And you're now getting closer to that tier system I was talking about. You've definitely cut through the 50% tier and you've dropped yourself between 30 and 50. So you've written down a whole tier, and your credit score after a few months is going to reflect, update, and then most likely improve just from having more available credit, a la opening up another credit card. So like Shabazz said, that's an easy way to improve your credit without having to do much work. That's why it's important. So even in my scenario, as somebody who is blessed to not have basically any debt, I'm still opening up credit cards because it only helps. I'm adding more limit, and I'm adding more types of credit mix, and I'm adding more accounts, which is going to help your credit score. I agree with you. The industry standard should be 5. That should be everybody's goal. You should have at least 5 credit cards, or be crazy like me, have as many as possible. The demonization of credit is justified when it comes to predatory lenders, which I don't like, but mainly because people don't know how to manage themselves with their credit cards. And they don't know how to recognize that. They don't know how to fix themselves with that. And that's the issue. The issue is never having too much credit because, as I've said before, credit and money are just tools. That's all they are. Credit and money are just tools. They are not the devil. They are not our Lord and Savior. They're just tools. Just like a hammer, just like a pickaxe, just like a video game controller, you have to know how to use your tool effectively. And in some cases, if you don't use the right tool for the right job, or you misuse the tool, then of course it's not going to work. And that's no different than credit. It's when you abuse the credit. It's when you don't pay people back on time. It's when you're spending on dumb stuff, which we're going to get into this. This is when credit becomes quote unquote bad. This is when credit, quote unquote, can ruin your life. This is when credit can, quote unquote, run your life and be the devil. But I'm sure if you're a listener of Financial State of Minds, whether this is your first time or 15th time, first off, thank you for giving the money counselor, Bonnie McFly, an opportunity. But you also know, or you also have some desire that you want to improve. And this is why me and Shabazz are taking our time to have this conversation, is we want you guys to improve. We want you guys to get to the goal of perfect, which is 780 plus or 800. So you mentioned one of the easiest things to do is to add credit. What I'll say, one of the easiest things to do, in my opinion, is paying that minimum payment on time. Again, we talked about earlier, payment history is 35%. So if you can just pay the minimum and you're on time, that's the best thing you can do. That's the best thing you can do to help your credit score. Now, Darrin, I ain't got it. I ain't got the minimum. We'll talk about some solutions in a little bit. But one thing I want to say is paying something is better than paying nothing. And to my understanding, that actually is reflected on your credit report. So on your credit report, it's broken down by months. Every month on your credit report, your full credit report will break down every month if you paid on time. And they actually have different scenarios. There's paying on time, being late, and there's how long you're being late. So what I always say is, if you're going to be late, which I don't encourage, but if you're going to be late, it is always better to be late 7 days than 15. It's better to be late 15 days than 30. It's better to be 30 days late than 60 days late. And it's better to be 60 days late than 90 days late. And it's better to pay at some point than to never pay at all.
True.
And why I break this down like this is most people have never seen a full, 20, 30, 40, 50 page credit report, or it's really broken down, or they literally, like my credit report is massive, like, because it's just one account over 14 years. And it literally every single month from 2011 to 2025, they have it marked. Darrin was on time, but there's that little area that could have been checked where I've been late 30, 60, 90 days. And this all impacts your score. And more importantly, the relationship you have with your lender.
What if you closed that account that you had for 14 years? What would happen?
In most scenarios, closing your account does negatively impact your credit score. The reason is, and we're kind of beating it down, but it's true, you're reducing your overall credit availability and limit. So that's going to usually impact the utilization rate, which is 30%. The other thing is that you're closing down a credit account period, which is going to usually reduce the overall age of credit that you had. And you're also closing down the account, which affects the mix of credit. So maybe that was your only credit card that you closed down. Well, now you don't have any credit cards. So that doesn't look good on a credit report. So I pretty much very rarely advise closing any credit. Very rarely do that. I advise always trying to pay it off. And if you can't pay it off, or negotiate it down, work with the lenders, something so that the account doesn't get closed. And to add on to that, as I continue this tangent, there's different ways of closing an account. One looks better than the other. If you're going to close the account, please close it when it has zero balance and you're doing it yourself. do not close the account when it has a balance, and you definitely don't want to be in a situation where the lender or the collection agency closes the account down. The latter is going to make the highest negative impact on your credit score compared to the former, where it's not that recommended, but it's really not going to impact your credit score as much. So that is what happens when you close any type of revolving line of credit. Is it's normally going to negatively impact your credit score.
Facts.
Yeah. I know we're taking a lot of time, and you've been listening to Darrin over here with Shabazz on Financial State of Minds at KGPC 96.9 FM. And we're talking all about credit and how to fix it. But I really want people to understand this is how the game works. This is how credit works. This is all what's happening in place as you're trying to go about your life. So this is credit. We talked about how it impacts your score if you close it. So now let's talk about, okay, credit is inherently tied to debt. People are in debt. The average American is in debt. The average American holds, I believe, $6,000 to $7,000 in credit card debt alone. The average American is paying anywhere from, I think it's $500 to $700 a month now for their car note. The average homeowner is paying, especially in California, you're definitely paying $3,000, $4,000 a month in mortgage if you got a brand new house. If you've had it for a moment, it's probably around $2,000. Right. But these are all debts. People get into debt for God knows the reasons, as you know better than me at this point. The amount of reasons are crazy.
Right.
But what's all the same is you're in debt. So, listeners, for the ones who are in debt, this part is definitely for you. You're in debt. Say you're a person, you're in debt, or you're a client as you were helping, that they're in debt. And I've helped people now with wild amount of debt, from as little as a few thousand and as much as hundreds of thousands, for a variety of reasons. Let me ask you, in your experience, what are the things people are most commonly in debt for?
They just don't, from what I see, it's a lot of reasons, but the main reason is that they don't have the discipline with credit. They're using credit in the wrong way. As we mentioned before, credit is a tool. The people that I coach, I always want to change the mindset, right? That's usually my focus. I need to change your mindset and reprogram your relationship with credit cards. Because most people, when I ask them, and I ask them so I can see exactly what they're thinking, I'll say, well, what do you feel like credit cards are for? Oh, basically when I don't have the money. This is the number one answer. When I don't have the money at that time, I could use that and I could just pay it later. And I tell them, no, that is the wrong way to use credit. And they'd be like, well, where's the way? I said, and this is how I kind of get people motivated into, this is the reason why you want the best credit score. This is why you want the best credit you could possibly have when it comes to your credit profile. It's because you want your credit to work for you. You want your money to work for you. This goes back to the bigger plan of Financial State of Minds, right? Mm-hmm. Where you want to get the best credit cards on the market, right? You want to get the credit cards that's giving you 3 to 5% cash back, because what we should be utilizing credit for is to create more money.
Right.
And that was the whole purpose of credit, even from the earlier days, before they even had credit, when they just had a credit system, period. It was, credit was produced to put in place to make more money, not to keep people in debt. That wasn't the key. That wasn't what it was intended for. And some of the clients that I've had over the years that actually adopt this mindset, some credit cards that will give you 10% cash back as an introductory for that first 3 months or that first $5,000 that you spend. And I tell people, what do you pay for every month? Like, no matter what you pay for. They'd be like, oh, my rent, my mortgage, my light bill, my cell phone bill, my auto loan, my car payment. Like, you're going to pay that regardless every month, right? Okay. Now, what if you put that on that high interest, that one that's giving you 5% cash back? What if you put that on the credit card every month and you paid it off? Then what would happen? And you consistently did that. You would get, after about a year, paying your mortgage, your rent, your car note, your light bill, your gas bill, your car loan, your cell phone, paying the regular things that you pay on a monthly basis. Guess what? If you pay that off every month, just like you pay your regular bills, do you know how much cash back you would have at the end of the year? I said you would get paid this amount of money just to pay the bills that you're already paying. And once they start understanding that and they start accepting this mindset, then they're like, okay, now I see what's the importance of having good credit. Now I see how this can work for me, how I can make this work for me instead of working against me. And I think that's the key. Like, I think that people don't really understand what they should be using it for. If you start highlighting these things to where it could work for them and where the things that you're already doing, it could just work for you with just that, then it's like, okay, I've been doing this wrong the whole time.
Right. If you're going to borrow money, in my opinion, and I agree with everything Shabazz has said, if you're going to borrow money, it better be to improve yourself. It better be able to grow yourself. That's it. If you're going to borrow money, it should be with the intent and goal to improve yourself or better your skill set or better your education, better yourself in general. If it doesn't fall into that, or if you're not using credit to buy or be on your way to buy an asset that appreciates over time or an asset that will produce income for you, to produce money for you, in most cases, you're not using your credit right, unless it's in those categories. Of course, I'm understanding as a financial planner, people get into situations where they have an emergency and they need money and they need to use their credit, and I get it. Mm-hmm. But as a planner, what I try to teach is that's the purpose of the emergency fund. Not having an emergency fund is an emergency itself. I will say it again. Not having an emergency fund is an emergency itself. Quickly, for those who don't know, an emergency fund is when you have money in a savings account that you can access quickly, immediately, that will pay for your bills for up to 6 months without you earning any income. That's an emergency fund. You need to have that at all times. If you don't have one, get on it. That's what you need to have. Darrin, why should we have all this money lying around in a savings account when I can just, if I get an emergency, put it on a credit card? We've already answered that question for you. But as a reminder, it's because you're paying interest on the money. And if you're especially somebody who doesn't have the best credit score, then you're paying a high amount of interest on that money. Right. And if you just simply have that money in your savings account, then you're not paying that interest. And what people need to understand is emergencies are going to happen. It's not a matter of if, it's simply a matter of when. Have you ever gone through life at this point and not had an emergency?
No.
Same thing with me. You guys have heard. I've had plenty of financial related emergencies in my life. It's just a part of life. So we need to stop treating emergencies as an if, and we need to start planning on emergencies as a when, which again connects back to credit. So if we're leveraging our credit correctly, there's basically no balances on there. You should have a fully funded emergency fund so that if you really have an emergency, heck, go ahead, throw it on a credit card that's going to reward you anywhere from 1% to 5% back in some type of rewards. Pay that balance off of your emergency fund, and now you've saved, and this is how I frame it, you save money when you use a credit card with benefits. You're saving 5%, 3%, 1%, 10% if it's an introductory offer. That's how you look at it. Look at it like a coupon. Look at it as a well, it literally is a rebate. That's how the tax people, that's how the IRS defines it. Mm-hmm. It's a rebate. That's literally how credit benefits are. But people generally understand that they need to have a good credit score. But this episode is for the people who don't have a good credit score. So let's talk about it. Credit repair. We'll spend the remainder of the episode. How do people repair their credit? We've given some hints already. But before that, you touched on something. Mindset. What I find with the overwhelming amount of people who are in debt is that it's behaviors that they chose to do that led them to the debt. The only exception to this rule is generally student loans. So student loan people, if you're only in debt for that, this is not for you. But for everybody else, if you're in debt, generally speaking, it's because of a certain mindset and behavior patterns that you've exhibited and you chose to act on that led you there. That's why I focus so much content on mindset, because that's what it is. And I see that with people who make $7,000 a month take home, and I see that people who make $2,000, $3,000 a month take home. I see that with people who make $10,000 a month take home. All of these people I've seen mismanage credit and money, all of them, because they all shared the same behavior and mindset. So first, you need to listen to all the episodes of Financial State of Mind. Yes, I'm self-promoting, to get your mindset right. That's the first thing you need to do. First, 0 point is recognize you're in debt. The first step is to get your mindset right. Get your mind right when it comes to needing to fix credit, why it's important, which is why I wanted to make this episode. But okay, you're what we call a good client. You want to fix your credit. Shabazz, how can people on their own take steps to do actual credit repair? What can people do?
Okay. You could definitely fix your credit on your own. There's ways you can do it. Usually, if people are going to do this manually, they would have to go to annualcreditreport.com, get their free 3 credit reports, find out, look and see that everything that's negatively impacting your credit, right? You know, collections, late payments, closed derogatory accounts, repossessions, so forth and so on, right? And it basically draft up letters to dispute any inaccuracies, thing that you see that's unverifiable with the credit bureaus, right? But of course, you would have to do that manually. It's still a manual process, even if you use ChatGPT, because basically you have to do all the research on the credit report, and you have to itemize all these negative items, and you have to dispute each one to all the credit bureaus that's reported to. So if it's reported to Experian, Equifax, and TransUnion, you got to write a separate letter for each one, right? So even if you ask ChatGPT, hey, I need to get this off my credit, and draft me up a letter on how to dispute them, you still have to do it all manually. You have to fill out the envelopes, and you have to go ahead and drop it off to the post office and mail it. And then when they come back to with a response, you have to figure out how to respond. So and this is coming from somebody who has done it for 2 decades. I've done it every way you could possibly do it. And manual is very time consuming, even if it's for one person. So a person doing it themselves manually could be a lot, and especially somebody who has, on average, 15 to 25 negative items. That is very time consuming, and that could take quite some time doing that manually. So you could definitely do that if you have the time. It'll be a lot cheaper than hiring a credit repair organization.
So quick interjection, is that all what a credit repair organization does essentially, is they do exactly what you explain on someone's behalf?
Yeah, but I imagine they use software. They don't do it manually, right? So there's software out there where you could do it yourself too, that makes the process even more effective. Because even if you do it manually and you get the free credit reports from annualcreditreport.com, you can only get one. And I hear a lot of credit gurus talk about this on Instagram and YouTube and so forth. Now, once you get a response back from the credit bureaus, you're not going to get an updated credit report. That's the thing. Right. Now you have to respond, and now you don't have a 3-bureau credit report that you could just look at, because Annual Credit Report only give you one free report a year.
Right.
So now you have to, it's just not an effective process doing it that way. If you have credit monitoring, now you have something that is updated each month that you go ahead and take a look at, and you can see the updates, and you can keep that process going. But once again, it's a manual process.
Absolutely. So you broke it down. If you were to go to a credit repair company specialist, that's exactly what they're doing. They're doing exactly what you laid out, but they're just doing it, and they're charging you very low end, high hundreds. Usually I see thousands for that whole process.
Right.
But if you don't have the time to do all this manually, yeah, that is an option. Go hire a credit repair specialist. Go hire someone who can do that on your behalf and be your representative. But another option that's out there is now there are AI tools and software that will do that for you. And you don't have to go to a person. You don't have to pay them the probably $1,500, $1,200, $2,000, whatever somewhere in the thousands is. You can use AI software. And that's something that now I offer now to my clients and the listeners. You guys should go ahead and check it out at financialstateofminds.com. There is an option for do-it-yourself credit repair. It's AI-powered. Pretty much what Shabazz just explained is exactly what you could do for yourself. The platform basically shows you how to do all this. There's videos, there's tutorials, but it's very simple to use. Anybody can do it, and it's definitely way less expensive than going to somebody else to do it. So please check that out as well. If you want more information, obviously check the website out, or you can reach out to me directly, and I'd be more than happy to do that. I'm excited to let people know that there's a cheaper option because, again, most people who need credit repair, they don't have the money. They don't have the money anyway. So coming up with a few grand can be challenging. So there are options out there, whether it's the manual way, whether you decide to go with a specialist, or whether you decide to go with the do-it-yourself software. There are ways that you can fix your credit and get back on top into a good place. So I can keep talking about this all day, but unfortunately, you guys, we're about running out of time. So I'm going to leave it there at this point. Shabazz, I want to thank you once again for coming on the show and bringing your insight. You've been doing this a lot longer than me, so I felt it was important to bring you on as I do this episode. But I hope, listeners, you guys got a basically one-stop shop understanding of how credit works, why it's important, the things you can do beforehand to improve your credit, and if it does get into a place where you need some help, you have some options on where you can go or how you can go about doing it. And of course, again, reach out to me directly. I do help it, whether it's coaching or through this software. I can help you get out of debt. But make sure you guys continue to listen. This has been Darrin Harvey, Financial State of Minds, on here at KGBC 96.9 FM. This is the show where I help you get to that bag, manage that bag, and grow that bag as best as possible as we continue to discuss financial literacy, personal finance, and everything related to the power of knowledge. Peace, kings and queens. We are out of here.